So workforce housing is important to us because it's housing for what I call the backbone of America. It's for firefighters, teachers, nurses, police officers, service workers like hotel and restaurant and retail workers.
I'd like to welcome our listeners to the Boulos Beat podcast. I'm your host, Greg Boulos. The Boulos Company is Northern New England's largest commercial real estate services firm with offices in Portland, Maine, as well as Manchester and Portsmouth, New Hampshire. We've been selling and leasing real estate in Maine and New Hampshire since 1975. This podcast is designed to provide insight into Maine's business movers and shakers. And speaking of business leaders, I'd like to welcome Kim Rogers to the Boulos Beat. Kim is a real estate developer and investor in both Maine and New Hampshire. Kim is also a 60-year-old father of two grown children, 32-year-old son Max and 30-year-old daughter Olivia. Kim grew up in Wilton, Maine and moved to York, Maine at the age of 11. From there, Kim went to Phillips Exeter Academy and then to Colby College in Waterville, where he received a BA in Economics and Administrative Sciences. Kim now lives in Portsmouth, New Hampshire with his wife Anya. In August 2011, Kim left his job as district manager and regional sales manager at the company True Blue. It's one of the largest private employers in the U.S. to take over the reins of the family's commercial real estate business from his father, George. Under Kim's leadership, the GL Rogers team has nearly tripled the assets under partnership, ownership, and management. The growth was accomplished through 3 successful private placement offerings and by repositioning commercial real estate assets to reflect the continuing growth of the online economy and the influence of changing demographics on spending patterns. Welcome to the Boulos Beat, Kim.
Thank you, Greg. I'm very happy to be here. I appreciate the invitation.
So, Kim, you were working at True Blue, which is the New York Stock Exchange company, to come back to Maine to take over the family business. What was the reasoning behind leaving such a lucrative career and coming back to Maine?
Well, at first I was a little reluctant to come back, and then as my father unfortunately got sicker and it became apparent that there was going to have to be some kind of transition in the family, and some of the family friends, investors that have been with the company for literally 30, 40 years reached out to me and said somebody has to come back and run the company and protect our investments and protect the family investments. And so I thought about it.
It was kind of an obligation that you felt?
Yeah, it was an obligation. It's the family has a lot of money, invested in commercial real estate assets, and the family is extended family. It's aunts, uncles, and then there's a lot of sort of family friends from my dad's generation that are investors or are investors. And so I felt like even though for me it was going to actually be a pay cut to come back and run the family business, that it was important for the family that I do that.
Are you glad you did?
I am. I was working, before working in staffing, I was working in the construction development business. But in staffing, it's a very high turnover. You're putting people out to work. You're always looking for new opportunities to put people to work, and so it's a very fast-paced environment. People sometimes do odd things on the jobs, and so there's a lot of customer service in the staffing business as well. And so when I came back and I took over the family company, commercial real estate is not a fast-paced
No, it's not.
business. And so at first I was sitting at my desk going, the phone's not ringing, people aren't running into my office, I don't have to fly somewhere.
It was an adjustment.
It was really quiet, yeah.
I invested with your father on one deal.
Oh, did you?
It was an oil well deal.
Oh, really?
And
wow.
I can't believe how poorly it turns out.
Yeah, exactly. Well,
I got a nice tax
if it's
write-off.
a dry hole, there's nothing to be said.
I think we went down like 1,500 feet, and he said, no, that's it. We're not going down any further.
Right.
And I'm thinking, just another 500 feet. Maybe there's something there.
Yeah, right, exactly. I spent a couple years out of college working for them, and they were really active in wildcatting back then. And they had some successes, but I would say for every good well, they probably had at least one dry well, if not more.
Yeah. For me, it was a learning experience. It was also enjoyable because I was investing with your dad, who I admired.
Mm-hmm.
But,
thank you.
So Kim, let me ask you about your name, Kim.
Right.
You're not Asian.
No.
And oftentimes, Kim's, what's the story?
So, my mom is from Finland, and in Finland they have a boy named Kimmo. And she's actually a Swedish-speaking Finn, and in Sweden, it's not uncommon to have a boy named Kim, but sometimes
as opposed to a boy
women
named
too.
Sue.
Yeah, it's like a boy named
Remember that
Sue.
song, Johnny
Exactly.
Cash?
And then there was Rudyard Kipling's Kim, which was written 60 years ago or so. And my mom just thought Kim would be a great name for me. My dad, who was American, was like, I don't know about that, and he tried to push back, but he didn't win that battle.
Yeah.
And so it's been interesting. I have to say that people certainly remember my name because it's unusual for a guy to have that name.
No,
but not unusual, but not unheard of. Every now and then I'll run into somebody who is also named Kim and who is a man. So,
and you have an instant bond.
Yeah, exactly.
So you moved back east. You took over the family business. What kind of properties and what kind of financial condition did you find?
Everything was really well run. My dad had a small staff that were very well trained, understood how to run the business, and but they were maintaining. There was no acquisitions. There was maybe the occasional sale of a property just for cash flow reasons. So it was sort of static, but the properties themselves were well maintained, and as you get on in years, your appetite for leverage in this business goes down, sure, I think for most people anyway in this business. And so I came in and I felt like things were pretty much under leveraged. There wasn't very much debt. And not that I like to go super levered on everything, but there was opportunity to refinance properties, take some money out, and maybe acquire another property, or
leverage it out and expand the portfolio.
Yeah, exactly.
Yeah, I mean, there is a thing such as good debt, right?
Right, exactly.
As opposed to bad debt.
Right.
And if used smartly, you can use it to your advantage.
Exactly. You want to. Debt service coverage ratios are really important to us. They're important to the lenders too, obviously. We look at it, especially on multi-tenant deals. If we lose a tenant, what does it look like? If we lose two tenants, what does it look like?
Kind of like a stress test that the banks do.
Exactly.
Right?
Right.
Now, Geo Rogers is not a household name, and I suspect you prefer to keep it that way.
Yeah.
But you own many properties. Is it intentional to keep a low profile, or do you just have a lousy PR person?
Yeah, so literally our office we're on the ground floor, in a one-story building in Portsmouth, New Hampshire, and we don't have a sign on the door. We don't have a sign on the building. We prefer to sort of stay lower key. We got involved in a partnership with the city of Portsmouth started 10 years ago, the process, and it was a lightning rod for newspaper, media, citizen concern, approval, disapproval, and so we've felt like it's better to sort of keep a lower key presence.
Keep your head down.
Yeah, just keep our head down. We're not trying to be famous or anything like that. When I came on board, we didn't even have a website, and I thought that we should have a website. I think that it's important to have a media presence. I've found that when we go to a broker that doesn't know us or a lender that doesn't know us, the first thing they do is they Google us.
Of course.
And check out our website. So our website is more informational. It's not really a consumer website. We don't sell anything on our website. But I think it's helped a lot to sort of lend credibility to our business. I mean, we've been around for almost 50 years, and a lot of people don't realize that. And if they go to our website, they sort of get a little bit of our history and a sample of our portfolio.
Let's go into some specific properties, and we'll be flashing on the TV screen photographs of the properties as you describe the company's history with them. So if you would give us an interesting nugget or two briefly on the following properties. Two City Center, Portland.
So Two City Center was acquired 30 years ago, 25 years, I guess 25 years ago, from the Bouloses.
Yes. Yeah, I sold it to your dad.
Yeah. And great building. We love it. It sort of was a more modern building in its day. It still is a modern building versus more traditional architecture. And Two City Center is in the middle of Portland, and it's a nice layout where we pretty much have a single tenant on every floor. It's not too big, so it's easy to do that, usually anyway. And we really like that building. It's well built, it's easy to maintain, and tenants really love the location and love the building.
And the management too. I will tell you that the tenants do like the management.
Well, thank you.
You guys self-manage, but.
Right, yeah, we self-manage, and customer service is really important to us on a number of levels. And one is we look at our tenants as customers. Yeah. And Sally Leary in our office is our point person for our tenants, and she does a fantastic job.
Does. She's been with you a long time.
She has, almost, well, I'm going to get into trouble now, but around 30 years, I'll say.
Yes. We could always edit this, you know.
Yeah.
Another property, Walmart Center in Falmouth.
Yeah, so Walmart, we sold that 7 years ago in Falmouth, and Walmart was going to go to a super center, so we signed a new lease. We bought out the lease on Hoyt Cinemas, and
Hoyt's was adjacent to Walmart,
yeah, adjacent
so they were going to expand into the
and they were going to expand into the Walmart, expand the Walmart into the cinemas,
yeah.
And then they started balking on that, and so, but we had an 11-year lease with them, and they were paying the rent for the cinema. And so we thought, well, they might do it, they might not do it. I also started we were looking at how internet resistant is Walmart, because in the retail world, we feel that's really important to find internet resistant retails, a retailer who can survive or compete against internet services. And Walmart at the time was not doing very well. They had a order it from Walmart and come pick it up at the store. It wasn't a deliver to your home type service. Mm-hmm. And they weren't doing very well at the time. And so we looked at that and we're just like, well, we got a long-term lease. Walmart is kind of wavering on going with a super Walmart. They're not doing really well with competing against the large internet retailers, dominated mostly by Amazon. And so we decided to sell, and we found a buyer, and I think it ended up being a good deal for them and a good deal for us, and we did a 1031 on that and traded it into two other properties.
I sold that property to your father. It was owned by, I'm pretty sure it was owned by Recall, which was an entity set up by the federal government that took over assets from failed financial institutions. And I remember your father purchased that for like $2 million, mm-hmm. and it was vacant. Yeah,
it was dark Kmart. Yeah.
And I remember asking your dad, I said, because I waited till after the closing, and I said, what was your motivation for buying this? And he said, Greg, where can you find 13 acres of land in the middle of the wealthiest community in the state of Maine.
Right.
And I thought that's how your dad's mind worked, and it
Right.
made perfect sense at that point.
Right.
But whereas before, I'm thinking, big, who's going to take, 80,000 square feet or whatever the size was of a vacant store? But your father had the vision. And so Hampton Inn, did you 1031 out of Falmouth to Hampton Inn?
Yeah, so out of Falmouth.
That's in Freeport, right?
Yeah, we did a like-kind exchange for 2 Hampton Inns, one in Freeport and one in Waterville, Maine.
So all of a sudden you're in the hotel business.
Exactly. It was, so my main strategy coming in was to diversify our portfolio. There's a lot of companies, and it works really well for them. They stick to a certain silo. Like they'll do big box retail, or they do hospitality, or they do industrial, or they do office, or even the medical office segment. We're small, and we felt like for us it made more sense to have assets in different silos, so that if one silo has problems, the other silos hopefully are, the other investments in the other silos are hopefully supporting the overall family of investors.
So in today's environment, if you've got industrial, which is doing well, it offsets in office space, which is not doing so well.
Exactly, yeah. And office space is okay. The challenge with office is just that every time a lease comes up for renewal, the tenant seems to be looking for either A, a discount, or B, less space.
Or retrofit.
Yeah, or C, wants a big build out, and so it's gotten very sort of labor intensive from a management standpoint, between rewriting leases, and sometimes they just want to leave because they want to consolidate and into maybe another location they have, or do something else. And so it's a lot of work.
When I look at office space, you got a vacant office space somewhere and you want to fill it. It's an expectation that the landlord is going to go in and put money into the space at the request of the tenant. So, and I compare that to an apartment that somebody might own, an apartment complex. The tenant comes along into an apartment complex, says, geez, I like this unit, I'd like to take it. But they never say, I like to take it, but you got to move the bathroom over here.
Yeah, right.
You got to get rid of that second bedroom. Really don't need that.
Yeah.
Open it up into the
Add
living room.
another bathroom. Oh, we want a kitchenette.
Right. Whereas office, somebody comes and says, boy, this space is great location. You even got some parking. What are you going to give me for a tenant improvement allowance?
Yeah, exactly. Because we're hiring a designer and we're going to redesign the space.
Yeah, that's.
And at 2 City Center, for example, a lot of the offices in that building are trimmed out with natural grain wood, oak, and for the most part, maybe some maple, and so a tenant comes in and there's all this really expensive maple or oak trim and baseboards and windows, and and they're like, we want to paint it all, and you're just like, no.
And then you say, well, wait, how long a lease? And what are they paying for rent?
Well, yeah, you can't. Beggars can't be choosers today in the office world. So
that is so true.
Yeah, so you just do what you're asked and try to come up with a reasonable allowance for a tenant fit up.
Tell us about One Hampton Road in Exeter, because you have properties in New Hampshire and Maine.
Yeah, exactly. So Exeter is our, because we have it under contract. So it may sell. We'll see. But it's our medical office play. It's a little over 80,000 square feet of medical office, leasable medical office space, and the building's bigger. But when you add in common areas, that's been a great building for us. It's the medical world is got through COVID a little better than maybe office space in general. However, at the height of the lockdowns and everything, a lot of medical offices were working on reduced staff and only providing essential services. And so there was some concessions that we had to, in the office world, we had to do concessions because of closed offices. In the medical office world, there was still some concessions there too.
I think one of the reasons medical office space is so popular of all the asset classes is that, generally speaking, you put a doctor's group into an office building, very expensive fit out.
It is very expensive.
It's very expensive for doctors to move.
It is.
Typically, they won't move. If
Right.
if they don't need more space, they'll stay where they are.
Right. Yeah, that building was only about 50% medical when we took it over, maybe even less. Our goal with that building was to get it to 100% medical or close there too, and it's pretty close to 100% medical now. And the build-outs have been very expensive along the way, but we've gotten that building positioned where companies that specialize in medical office buildings were interested in acquiring it. Mm-hmm. Whereas before, when it was slightly less than 50% medical tenants, it kind of was in a no man's land. And so, there was a lot of interest as we ramped up more medical tenants and did the build-outs associated with those tenants. There was more interest from REITs and private equity firms that specialize in medical office buildings, and just became, even with debt being a big challenge today, it seemed like a good time to sell.
Deer Street in Portsmouth, let's talk about that area. You at one time owned basically that whole street.
Yeah.
Let's talk about the parking garage in Portsmouth, which is on Deer Street.
Right.
As I recall, you planned to build a large parking garage, but ultimately sold the land to the city. And why was that?
Right. So Deer Street, the family started acquiring assets there through a partnership in 1984. Mm-hmm. So what would be today 40 years ago, 39 years ago. And with the idea that this at some point, because it's central to Portsmouth, would be a great redevelopment opportunity. This land was partially originally railroad land, had seen a 1970 urban renewal action where the train depot was torn down and, little strip mall was built and,
We had that in Portland too.
Yeah, and so some really great architecture was torn down, unfortunately, for some not so great architecture, but it is what it is. And it was, when my dad acquired it, it was really something that he thought that we could redevelop at some point, but he never really had the appetite for it. When I came on board, some neighboring land became available, so we acquired it. And then I started talking to other neighbors, and we were able to acquire some more land, and we bought some more land from the railroad. And we actually amassed trying to remember now, about 3.5-4 acres of land in downtown Portsmouth, all developable.
Which is a lot.
It's a lot of land for an urban city, environment. And so we did a master plan. We were going to do 4 buildings and a smaller parking garage, just to sort of suit the needs of the buildings that we were envisioning. And then the city came to us and said, "Wait, we hear you're going to build a parking garage. We need another parking garage in Portsmouth. What are you doing?" We explained that we were going to build just a little one for our needs. And they were like, "Well, can you get us a bigger piece of land and then we can build a big garage?" And first we were going to build it and lease it to the city. And then we were going to do a land lease, but they really wanted to control the garage themselves. They wanted to own it outright. So we just sold them the land, and they built the garage, but we still needed parking. And it became apparent that we weren't going to be able to have all the parking that we wanted if we sold the land to the city, but we could retain at least the essential parking that we needed for the 2 buildings adjacent to the municipal garage that we had envisioned.
And you ended up with 68 parking spaces?
Yeah, 68 parking spaces in a 612 car garage.
And would you do a long-term lease of those spaces?
Yeah, so we had an agreement, a contract with the city, an agreement to acquire up to 68 spaces as we completed our development projects adjacent to the municipal garage.
So those spaces were designed to accommodate future development that you had in mind for them.
Exactly. Yeah. Right. And we had to pay the lease, it was a license or a lease, you can call it either, that envisioned we have to pay, for those spaces. We pay the lowest contract rate that the city has,
Yeah.
So
But you're paying market, but at the lower end.
Yeah, we just paid the lower end of the market rate.
So tell me what happened when a new city council was elected, which ran on an anti-development platform.
Right. So, it wasn't an easy process to start with because new development in any seacoast city is a lightning rod for controversy. And then add in a partnership with the city and, we're taking advantage of the city. And, there's just a lot of people.
You're such a mean person.
Yeah, I know. And people just, including the press, just don't understand the complexities and the costs involved with doing any kind of a development. And so when they see big numbers, they don't understand the land acquisition involved and, years, of acquiring and holding land, to put together a big enough parcel for the city. Yeah. And, but we got through that process. It took years. We got through that process. The city acquired the land. We had the contract signed. The license agreement was signed, and they moved forward, and we were going to move forward. And then, literally, though, a few months later, there was new elections, and what I would consider an anti-development city council was elected, and they ultimately decided they didn't want to honor the license agreement. Which
had been signed.
Yeah, which had been signed, and became problematic for us because we were depending on that parking for our land use approvals. Our planning board approvals included parking in that municipal garage as part of meeting the zoning requirements.
So I'm assuming a lawsuit ensued, or?
Yeah, unfortunately. We tried for a year to try to work things out with the city. Meanwhile, we're going to planning boards and zoning boards of adjustment to ask for extensions, and with some success, some not success. We couldn't go out, and we didn't feel like we could go out and explain to the general public that we felt like the city was reneging on a contract, and politically, it just didn't seem very feasible for us to try to throw anybody under a bus. And so we were trying to work it out with the city. Ultimately, we couldn't. We lost some requests for extensions. We pulled some permits to cement the land use approvals at that point, continuing to try to negotiate, and then unfortunately have to file a lawsuit against the city. Which was resolved after about a year and a half. A year and a half after we filed the lawsuit, so now we're like 2.5, 3 years down the road.
Did it go to court, or was it out of court settlement?
It was out of court settlement.
So explain to me, you got a signed contract with the city.
Right.
How could they justify not honoring that?
Well, it's political. It's political reasons. If you feel like your constituency elected you, right, because they want you to control development in downtown Portsmouth, and Portsmouth is growing quickly. There's a lot of construction in Portsmouth, and I understand the sentiment, as far as people feeling like maybe Portsmouth's growing too quickly and there's too much change. I may not agree with that, but obviously I'm in a different position than other people. But I can understand where they're coming from. But to then turn around and justify, basically breaking a contract with a developer because your constituency doesn't want to see that development happen right now is, it gets a little dicey for everybody, including the city. And then a lot of people got really upset with that city council because it put the city at risk for a lot of money.
Yeah, sounds like it.
Yeah.
So you had a number of lots on Deer Street. What's happened to those lots? Has a hotel went up?
Right. So we did this master development plan, 4 lots. It took about 3 years to just negotiate the sale of the property to the city. And then, we started going through another year and a half of trying to get the city to honor the contract and then the parking contract. And then, a year and a half of losses. So we started to lose our appetite for developing in Portsmouth. We're carrying a lot of land that we had on two of the parcels torn down the buildings in anticipation of moving forward. And so we decided that out of the 4 lots, we'd sell 3. And so we've sold 3 of the lots to other developers, and one of which is a hospitality developer and operator.
Have they built the hotel?
They haven't yet. They just acquired that parcel, I'm going to say 6 months ago, maybe a little less. Yeah, 4 months ago, actually.
And then for the other lots, do you know what they're planning?
And then the other 2 lots were acquired by another developer, and that was a little over a year ago. And they are going to build, at least on one of those 2 lots, a condominium, high-end, large footprint condominium building. Large footprint for the condominiums, not necessarily the building.
Right.
But
and then you retained a lot for yourself. You got bulldozers down there the last time I was there.
yeah, exactly. So we retained one of the 4 lots. It was actually, for some reason, it was also a residential project, and we just had a hard time getting any. We wanted to retain the hospitality project. We really wanted to build the hotel. But I had a lot of buyers, or I should say we had a lot of buyers for the hotel lot. Interestingly enough, not a lot of buyers for the residential project. I think part of that is, as debt costs were going up, and that was an apartment project at the time, the costs of construction have gone up greatly in the last few years. And so you're looking at high costs of construction.
Rising interest rates.
Yeah, rising interest rates, which translates to a high cost of debt. And to meet, I was talked earlier about debt service coverage ratios, right? To comfortably meet debt service coverage ratios on apartments, even with today's rents being quite high, it was difficult to pencil out. And so a lot of potential buyers just couldn't see it at this time. So we retained that project, and we actually decided to convert it to condominiums. The way we had designed it, it was going to be a luxury apartment, so we had already done double walls and pretty high-end finishes, and double walls for sound insulation, and concrete decks, and so it was already designed for either condominiums or high-end apartments. So we decided to make it condominiums.
Speaking of housing, can you talk to us about workforce housing?
Yeah, so one of our things, which we're not doing, unfortunately, in our current project, is workforce housing. And
what is that exactly?
Yeah, so workforce housing is important to us because it's housing for what I call the backbone of America. It's for firefighters, teachers, nurses, police officers, service workers like hotel and restaurant and retail workers. It's the working people of America, right? And we have a shortage of workforce housing. And so I spent 9 years on the board of the Workforce Housing Coalition for the Greater Seacoast, which was Seacoast of New Hampshire and southern Maine. And it's an advocacy group designed to bring awareness of where workforce housing can go in to the Seacoast area to help alleviate the shortage of housing.
And a lot of people, if I'm not mistaken, mistake that for Section 8 housing or...
Yeah, exactly. Well, one of the things we used to do is design charrettes in the local communities, and a design charrettes where you get a bunch of people together who are technically adept at designing and engineering housing, and then you get the community in there too, and people would walk in more often than not with the attitude that this is going to be low-income housing, and low-income housing is needed too, but low-income housing can sometimes carry with it a stigma of drugs and graffiti and crime, and but this, and that it may not be true either. But we're not talking low-income housing here. We're talking really housing for the really important people, and it's important people for the community, because they provide essential services on a number of levels, whether it's medical, municipal, private. It doesn't matter. These people are working there to make our lives better. And of course, they get paid for it, but it's important for them not to have to commute 45 minutes to their job.
Yeah, a lot of times, more often than not, they can't afford to work in the communities. I mean, live in the communities where they work.
Right. Where they work, they can't, And Portsmouth has a housing authority, and they do a great job at building some workforce housing, but it's limited on how much they can do. Maine has a great workforce housing developer, goes by the name of Vesta.
Oh yeah.
And they're in the world of workforce housing developers, they're one of the biggest.
We've interviewed them on the show before.
Oh, have you? Yeah, great.
Yeah, great people.
And they do a great job. But again, they're just one organization. And most of the workforce housing developers, whether they're housing authorities or not-for-profit developers like Avesta and other ones, they depend on tax credits, and their tax credits are limited. There's this whole system of generating tax credits that a state will sell, right? Mm-hmm. And then they get revenue for selling those credits, and then they give that revenue to the housing developers, and which is a great system for mitigating the higher costs of construction and the higher costs of land. But it's, again, very limited, and that's why you don't see more workforce housing developers.
There's a certain allocation that the government gives the different states.
Exactly.
And when you run out of it, in any given year, you run out of it.
Yeah, exactly. And so, and they always run out of it. It never goes unused.
Hey, let's switch back to hotels. So you own hotels in Freeport, in Waterville. You acquired them pre-COVID. I'm sure you're doing well. COVID hits. How did you manage through all of that? PPP money?
Yeah. Well, with a lot of angst when, the governors shut down the hotels. It was, among other things, not just hotels, but, when those lockdowns hit and many businesses were shut down, including hotels, I should say, there was a lot of angst. Because, you still have to pay your salaries of your employees. You still have a mortgage. You still got to heat the buildings. So, you still have utility costs. You still have salaries. Sure, maybe hourly workers are getting laid off, But then the government stepped up with a couple of different programs, PPP being the most substantial one, and we actually ended up retaining a good number of the hospitality employees, and basically we're reimbursed and then some through the PPP program, the federal.
And you were shut down, but not for a long time, right? Or am I mistaken?
I'd say about 3 months.
Was it that long? Yeah. And then they lifted the ban on hotels,
right.
And hotels could open up.
Yeah, and then they opened up, but with a lot of restrictions.
Yeah, checking for COVID cards.
Yeah, and I almost think that our hotels may have been shut down for 4 months or 5 months.
Yeah, that's a long time.
Because the hotels that could open up after a couple of months or so were hotels that were doing a lot of essential business, they called it, yes. I guess is what the term was. And essential business being like truck drivers who needed a place to stay because they're moving, goods around the country, which has to happen. Food still needs to move, right? Yeah. Clothing still needs to be, moved around. And so there was a lot of essential workers, medical staff, moving around to different hospitals and needed places to stay. But our 2 hotels were just not positioned for that type of business.
It was more tourist.
Yeah,
based.
our hotels were more tourist and business traffic oriented.
Did the banks work with you?
They did. In fact, we had some savings, so it wasn't an immediate crisis, but we knew in the long term it was going to be a crisis. Yeah. But before we reached out to our lender, they called us and said, hey, we're looking at all our hospitality clients and talking about doing interest only or suspending payments. And I thought that was...
for 3 months they did it.
Yeah. Right? Well, we ended up negotiating an interest only. We didn't suspend payments. We did an interest only for an extended period. I think it was 12 months.
Really?
Yeah.
Yeah. The banks, I think, in this crisis really stepped up.
They did.
And were proactive.
Right, exactly. For the most part, yeah.
Let's talk about personal guarantees. So you take out a construction loan, you take out a loan on a building. How do you feel about personal guarantees? Because the banks oftentimes ask for that. Yeah.
Well, especially in construction. There's almost no way you're not going to do personal guarantees on that. So it's just a way of the world, I have to provide guarantees on some of our debt. It's dependent on how much debt there is relative to the value of the property. Right. The loan to value ratio determines a lot of times whether I have to provide a personal guarantee or not. But it has to happen. One of the interesting things was when I came back, I was not really much of an owner of anything. I mean, I had some investments with the family, but not a lot, right? And so it's for me to be guaranteeing the debt and not really have any ownership or maybe not any consequential ownership of that partnership.
It's asking a lot.
Yeah. So I would charge a fee anyway, just to make myself feel better about it.
To the family.
Yeah, to the partnership.
Partnership.
Yeah, right.
I hope it was a big fee.
Well, deals are pretty tight these days. It's hard to charge a big fee.
So we were talking about partners. Do you have many partners in the developments? I mean, particularly the new ones.
Yeah, we have. I don't know. I mean, I would say we probably have about a dozen, I'm going to say families that invest with us going back 40 years.
Dozen families, really?
Yeah. And because these would go back to my dad's generation who's passed away. And a lot of those people that were investing with my dad have passed away, but the families have stayed on with us through their heirs. And
limited partners?
Yeah, limited partners. And then we have a new round of limited partners that since I came back on board that we've developed that is probably about 20, family investors. I mean, they're all individuals.
How is that
families.
Interacting with family members or others in terms of your developments? I mean, is it clear sailing or is it a pain in the neck? And remember, they're going to be watching.
Yes, I understand. Investors are great. Yeah. We have a good group of investors. For the most part, we don't have a lot of trouble. We try to be good communicators. We send out financial statements on every partnership quarterly, at least try to. Yeah. If we don't, it's because maybe we just forgot to do it that quarter. But I think we're pretty good about getting everything out quarterly. If there's some important news that we need to communicate, we'll do a little cover letter or email with the quarterly reports. So I think people know what's going on, and that communication, I think, helps to keep sort of investors from getting too anxious. But I tell you, when you have a bunch of investors in a project and you're suing a city and everything's stalled, there's a lot of nervous people, because they have a lot of money at risk.
Yeah.
And
A lot of pressure on you.
yeah, and so the good news is for them that, well, the underlying assets, the real estate, is still there.
Solid.
Yeah, it's there. So the bad news is we can't control necessarily the process, and we have to go through it, as need be. And
There's an expression: partners are for dancing.
yeah, partners are for dancing.
Yes.
I've never heard that one before.
It's,
Yeah.
oftentimes true.
So doing like the tango.
Whatever you want. As we sit here in mid-June, early June, prime rate's at 8.25%. It's really spiked up.
Yeah.
And I'm wondering, how's that affecting current developments or your plans for developing in the future? And do you have any variable rate loans?
We don't. We don't have any variable rate loans. We don't have any debt maturing right now. So most of our debt was put in place more than 3 years ago. And so we're still enjoying fairly low rates on our debt. We have some debt that will be maturing in 2 years. We're a little nervous about that. As I mentioned earlier, we're looking at selling the medical office building in Exeter, New Hampshire. And if we sell that, we are going to try to trade that into another type of asset, either hospitality or retail. And we're looking at pretty high debt rate, pretty high interest rates on those. And, it gets a little tight, as far as rents coming in, interest payments going out, and, structuring the deal so that it works. But we look at that really as more of a shorter term, and, we really feel like it's a good time for us to sell this one asset, and it's forcing us to be in a position to buy some new assets. And, prices have come down a little bit because of the debt, but not as much as a buyer would like to see.
Right.
And so we're looking at it as, well, we just might not make as much money as we'd like to, or maybe not much money at all for a couple of years until what we think interest rates will come down and normalize
and do a refi.
Yeah, I don't think we're going to be looking at 2 or 3% interest rates again.
Those days are gone.
Yeah, I think it's going to be a long time before we see that. Of course, I've been wrong before, but I do think interest rates are going to come down to maybe the 4%, 4 to 5% range, whereas right now, we're looking at, we're getting quotes on some of these things we're looking at. One lender came in at 8.75% on, and we're like, wow, that's really crazy high. But most of the lenders are coming in around 6.5%, 7%.
Yeah, that lender just didn't want the business.
Yeah.
I would say. I remember when I got in the business in the 80s, mid 80s, interest rates, prime hit 22%.
Yeah.
And, so that's always stuck with me.
Back in the stagflation days.
Yes, and I've always thought, interest rates have a chance of going back up, and it's kind of like a pain body. I just remember that.
Right.
But I think you're right. I think the rates are going to stabilize. And matter of fact, the Fed paused yesterday.
They did.
Increasing
Yay.
rates. Yeah, for a while. But they said that they'll probably still do something.
Well, they'll still look at it anyway. Yeah. So hopefully, I think that, personally, I think that a lot of our, oops, I'm hitting my microphone. Sorry about that. So personally, I think that a lot of our interest rates hikes and inflation worries were really energy driven. The price of oil, which we follow pretty closely, while we're not drilling new wells anymore, we still have some producing wells, and so we monitor what we're getting. And you start seeing oil going up over $100 a barrel, over $120 a barrel. This just keeps going up, and the cost at the pump. I mean, I don't know if you remember, but it wasn't long after the changeover in the presidency that gas was like $6, $7 a gallon at the pump.
Yeah, it was expensive.
It was really expensive. And so, and fuel costs drive everything. From production of agriculture to transportation of agriculture to processing of agricultural products, and certainly hard goods,
It's in
soft
plastic,
goods.
it's in everything.
Yeah, exactly. And so to think that you could have oil prices go shooting up, and the cost of gas and diesel fuel go shooting up and not get inflation, was, I think, a little naive, because a lot of the people at the Fed Reserve and at the Treasury were saying, "Oh, this is just an interim issue."
I believe the term was transitory.
Yeah, transitory. Yes.
I'm looking at that saying, what do I
It's
know?
only
But
transitory
now I
for as long as fuel prices are going to be up there. But and I think and then the Ukraine war, and there was a lot of factors, obviously, that impacted the economy to cause the inflation. But those things aren't necessarily controllable by the interest rates that the Federal Reserve's charging, And so I would like to see them pause. I think that if they keep going, they're going to push us into a recession. And I think that there's a delicate balance there. Hopefully they haven't gone too far already.
Yeah, because this is a delay. It takes a while for the
There
interest
is a
rate
delay.
effect to go through the economy.
Exactly.
Kim, give me some general philosophies on how you run your business.
Win-win. Yeah, we really strive for win-win. And when we say win-win, we look at everybody's a stakeholder for us, whether it's our lender, it's our insurer, it's our employees, it's our tenants, employees.
Commercial real estate broker?
Yeah, commercial real estate broker is really high on the list.
You know your audience.
Everybody's important. And everybody's a stakeholder, and it's about trying to foster a win-win solution for everyone, and which is why, when we have a tenant and they need help with a tenant fit up, and we look at ways that we can provide that. Sometimes we finance part of it with the tenant. We raise their rent for a period to help pay for some of that allowance. We're giving them some of that allowance by virtue of them coming on as a tenant, and just try to create a win for them, a win for us, a win for the broker who's going to get paid for bringing the tenant to us.
Right.
And our employees, like I said, we have employees that really care about our tenants, and so when they call in, right, with a concern or a problem, we're taking immediate action on it, and we follow through. Very rarely do I hear back that we've dropped the ball on something.
Virtually every landlord says what you're saying,
Yeah.
but I actually know from personal experience, because I'm friends with a lot of your tenants,
Right.
that in fact is the way you operate.
Right.
Looking at all the investments, we haven't covered all of them, but looking at the investments that you own, the developments, do you have one that you're particularly proud of, or what's your favorite? Or least favorite?
No, I'd say our favorite is our 2 hotels. Even though with COVID and there was a lot of angst and cash flow issues there for a year, our favorite, on a number of levels. First of all, we partner with Main Course Hospitality Group.
Peter Anastas's group.
Yeah, Peter Anastas, Sean Riley.
Yeah.
And company, and they are really good at what they do, and they're a pleasure to work with, and they really treat their employees very well, and there's a lot of synergies there in attitude and philosophies and business culture. So we really enjoy working with them, and they do a fantastic job.
Yeah, they do.
And interesting enough, when we went to acquire those 2 hotels, there was some family members and investors who were like, hotels? What are you thinking? And I'm like, well, let's talk diversity of portfolio and investments. And they were like,
Well, the nice thing about hotels is that with inflation, as inflation goes up, you can change the room rate nightly, right?
Yeah, right.
You can't do that with industrial properties or office buildings where
Exactly.
you have long-term leases.
Right.
So that's the upside. The downside
is on recessions.
those rates start to come down very quickly.
Yeah, right. Yeah, exactly. So it's we've had a good run with those hotels, even with COVID, and again, I have to thank the many people that are involved, the staff of those hotels, Main Course Hospitality Group, our staff. It takes a village to make something successful. But I'm particularly proud of those two investments because they've done well, and it was something new for us to do. And there is risk when you try to do something new.
You do business in Portsmouth and Portland. Pros and cons of the two cities?
They're very similar in culture, design, priorities. I mean, the people of Portsmouth, the people of Portland are very similar. There's a lot of people who grew up in Portland that live there. A lot of people who grew up in Portsmouth that live there. A lot of immigration, so to speak. A lot of people who come in from away, right? And I think that causes some angst for people who have grown up there. And so you get this sort of concern about the growth. You get the concern about development. And but both beautiful cities, both great cities.
On the water.
And both on the water. Very similar economies. Portland is bigger, substantially bigger.
So Portland's got a housing shortage. Portsmouth too, or?
Yeah, every place has a housing shortage. I don't know of a place in the United States anyway that doesn't.
What about parking? Parking shortage and, well, you know what, I should back up. Pre-COVID, huge parking shortage in Portland. 4-year waiting lists in some of the garages. Not so bad now, right? Because a lot of the office tenants.
Yeah, because people are working remotely.
They're still working remotely. Portsmouth, same thing, or?
Yeah, so actually, because Portsmouth, when they built the Foundry Place garage, which was finished. Oh boy, now you're testing my memory. I think it was either 2018 or 19, maybe 2019, and it was finished at the end of 2019. Then COVID hit, so it hasn't probably seen the utilization that they would like, plus the delays in our projects, because that garage was partially there because our projects were going to need parking, even whether it was licensed or not. And so the delay in our projects had the ramification of that garage not getting very well utilized. Utilization is up. It's allowed the city to remodel its garage, but Portsmouth kind of figured out its parking problem by building that garage, and even with the developments on our lots or former lots, I think that Portsmouth is going to be, because of remote working, is going to have plenty of parking.
Looking ahead, what do you see as some of the major obstacles to growth for real estate in Maine and New Hampshire? Is it the interest rates? Is it the governmental, hurdles you got to jump through?
Well, when it comes to development, interest rates and, government regulation, the land use process has become so cumbersome and so expensive. And, nobody has much pity on a commercial developer. But where I saw it really impact is when you start talking housing, workforce housing, and you expect, a workforce housing developer to spend $1 million on a project before they even put a shovel in the ground, just try to get approvals. You know what I mean? It's really expensive, and the cities just don't understand, how complex the permitting, the land use process, the planning board approvals, the, technical advisory committee approvals, the historic district commission approvals, the zoning board of adjustment approvals. if you can get them even. And then if it's just gotten so complex, and there's a lot of back and forth, and it just, eats up a ton of time, and time is money, because you're using architects, engineers, and consultants, even the land, pristine, never touched land doesn't exist anymore. So you're dealing with significant environmental issues on almost every piece of land that's available to develop, because it's had other uses. And sometimes, you think those uses have been innocuous, but in the 1700s, early 1800s, people heated their homes or businesses with wood or coal, and they threw the ash out the back door,
Sure.
or out in the front yard. And it creates actually a hazardous waste situation, and certainly not a high level one, but you start dealing with anything from moderate level. I mean, it's almost no site that's developable today, short of going out in the woods.
That's pristine.
Yeah, is pristine. And so you have environmental issues, and the environmental regulatory world has gotten just crazy high. I mean, we have some land that was contaminated with coal and wood ash, and it requires that those soils to be landfilled. They can't be just dumped in a pit somewhere, And so the regulatory costs are just huge.
In Portland, we have rent control on apartments.
Yeah. Right.
Yeah. Has that gone down to Portsmouth?
It hasn't. I mean, Portsmouth is, I don't know what's legal or not legal in the state of New Hampshire when it comes to rent control. I think, certainly if you do a workforce housing development, right, and if you're getting tax credits or some kind of governmental subsidy to build those apartments or those condominiums or those homes, whatever they may be, there's going to be rent control on those, all right? You're going to be required to meet a certain level of rent that depends on the average income,
Right.
And there's a whole formula that they use.
But you're getting something in exchange for that.
Right, but you're getting something for exchange. As far as I know, there isn't anything that isn't incentive-based. Even for workforce housing, in New Hampshire, they can't require like 10% of a housing project be affordable housing, workforce housing. Mm-hmm. They can provide incentives in New Hampshire. So bonus incentives, like you can build a taller building or a bigger building, or those kinds of incentives to get a developer to voluntarily put workforce housing in their project. I think in Maine, it's a little different. In Maine, they can require, a certain number of units be workforce housing. They may have rent controls that can be put into place. I think in New Hampshire, it's just different, interesting neighboring states. You think same laws, but actually different enough that whereas you see that in Maine, you don't see it in New Hampshire.
As I see it, the problem with rent control in Portland is that developers who want to build here have scrap plans to build here.
Right.
Now, there are a couple of projects going up, but those were pre-approved prior to rent control, and it scared a lot of developers away, and that's unfortunate because, supply and demand, you build more apartments, then the chances are rents will stabilize or maybe even come down. But when you restrict the number of apartments that you have, you're not going to get any new development.
Yeah, exactly.
And so the people who are pro-rent control presumably are doing that because they want to have more affordable housing, but actually in the end, it hurts them. And
Right.
I don't think they understand that.
Well, the problem, rent control, I don't know. I mean, do they allow for escalating the rent for inflation?
Minimal.
Minimal?
Yeah, it's a complex formula, but I think it's like 70% of CPI or something like that.
Right. Well, because costs go up too. So, if you're if maybe you're starting out profitable, but then over the years you can't raise your rents enough to keep up with your costs, then it becomes
Then
an
the
issue.
buildings suffer.
Yeah,
You don't put the money
exactly.
back into the property.
I don't know a lot about Maine, but I have a friend who's a developer in Massachusetts who was going to do a fairly sizable Massachusetts project. And in the course of them sort of getting the plans put together, entering into the land use process, the city changed the zoning and required a 25% workforce housing percentage.
Yeah.
And, and that project went from, okay, higher debt rate, higher costs of construction, higher interest rates, higher debt costs. It went from just being marginally profitable to, no, can't get done.
That's right.
And then the city was really upset that they weren't going to build it, and and a lot of bad press on that, and because the political process doesn't understand necessarily the costs and profit issues.
Yeah, we see that as well. Just going back to the hotels for a second, do you see a real estate bubble in the hotel business?
I do in some areas.
Like where?
Well, there's been a lot where there was a lot of development.
Like Portland?
No, not Portland, actually. I know Portland feels like probably, and Portsmouth also, they feel like there's more hotels than can possibly be warranted. But those hotels do really well and have done really well, over the years. We don't personally own a hotel in Portsmouth or Portland, but we know people who own hotels in those markets, and they've done pretty well. But where they haven't done well is like in major urban markets like Boston. The hotels there, because the conventions, the trade shows, haven't come back to where they were before, and there was just tons of build out, and so they're, Boston's been looking at very low occupancy rates even last year, where Maine and New Hampshire saw some of the best occupancy rates that they've seen for years.
Right.
And so, so some markets, like Seaport area of Boston, overbuilt and suffering. Houston, Dallas, there's Chicago, a lot of these big cities. And when it comes to leisure traffic, if you can go to Portland or you can go to Boston, a lot of people are choosing to go to Portland or Portsmouth. And so those hotels do really well because they're nice, clean, more quiet cities with good food choices, good venue choices, boutique retail, everything that a tourist wants to see.
Generally safe.
Yeah, generally safe. And also close to a lot of outdoor venues, ocean, mountains, beaches.
So let's look into your crystal ball next 10 years. Where do you see commercial real estate in Portland and Portsmouth? Are you bullish on it?
I think so, because, one of the things that we did is, when we started looking at, we started a major construction project for our company anyway in Portsmouth 3 months ago. And so literally went into the ground or 2 months ago. And, had to look into our crystal ball and say, well, where's the economy going and what are things looking like? And when you look at Portsmouth or you look at Portland, you have to really look hard and far back to find seriously bad times, high vacancy rates, for residential or commercial. There's been periods where it's been more elevated than it is today, for sure, right? But those two cities have done pretty well throughout the history of the recessions.
With Portland, I always say, compared to Boston, Boston goes like this, and then it goes like that.
Right.
In Portland, historically, at least as long as I've been in business, it's kind of gone like
Yeah, it's kind of an upward climb with some slight dips and ups and downs, but it seems to always be climbing. Or maybe during a recession it kind of flattens out,
right.
But you don't see these big drops.
Right.
And so I think, again, so it depends on where you're talking, but I think for northern New England, everything north of Boston, I think it's going to be fairly stable even if we hit a recession.
I think you're right. So, Kim, just to wrap things up, tell me about GL Rogers in 5 years.
Well, the thing about family businesses is that usually the family keeps expanding. So, I have kids, my brother has kids. My brother doesn't work in the business, but, they're still part of it, right? And his kids and my kids are the next generation. And so, it gets bigger and bigger. And so the company has to get bigger and bigger to support a growing base.
Yeah, a lot of mouths to feed.
Yeah, right. A lot of mouths to feed. It's, so there's the family aspect, but the idea is to continue to grow this company, provide, good returns to the family of investors, and to continue to do what we do, and continue to try to maintain a diverse portfolio of real estate assets and partner with organizations where we can see a strategic relationship will benefit both us and them and our investors. So that's what we'll do. I don't think we're ever going to be huge. I mean, there's a lot of really big companies, REITs, private equity companies that are more urban-based, like, big city-based companies that just have a lot of money. Right. And we're always going to be, I think anyway, northern New England-based, whether we were in Maine for 30 years and now we've been in New Hampshire, or we were in Maine for 40 years and now we've been in New Hampshire for like 7. So, 47 years, give or take, 50 years, give or take, where our age. But, so I think we're always going to be northern New England based. And by virtue of that, there's a lot of capital sources, in northern New England, but it's not the same as if you're working in New York City or Boston or Chicago or DC. Major cities, there's just a lot more capital, equity, debt available for, investment.
Yeah, I mean, these are still secondary markets.
They are secondary markets. And it's not only secondary real estate markets, but it's almost secondary debt markets, it's secondary equity markets. It's, you're dealing with families, and individuals, not institutions for investors.
Just remember, partners are for dancing.
Yeah, partners are for dancing. Okay.
Hey, Kim, thank you so much for being my guest on the Boulos Beat. This was very interesting. I enjoyed it.
Okay, thank you. I've enjoyed talking with you too. Thank you for inviting me.
My
This
pleasure.
has been fun.
Thank you. Kim, thank you for being our guest today on the Boulos Beat, a Boulos Company podcast. I really appreciate you taking the time to chat with us. You can learn more about GL Rogers & Company at the company's website, which is glrogers.com, and on LinkedIn at GL Rogers & Company, Inc. And if you'd like to learn more about the Boulos Company, please be sure to visit us at www.boulos.com. You can also find us at the Boulos Company on Facebook and LinkedIn, and at the Boulos Co. on Instagram and Twitter. And lastly, if you want to know the secret to owning real estate, it's pretty simple. Just be sure to outlive your debt.